price-to-earnings ratio, or PE ratio as it's better known, is one of the most important tools for determining if a stock price is overvalued or undervalued. The price-to-earnings of a stock is its market price divided by its earnings per share.
Price-earning ratio is used to value a company's worth by comparing stock prices towards earnings. It is about how much we pay for every ringgit of earnings. When the PE ratio is low, which means the price is also low and investors start to sell their shares. When the PE ratio is high, the price also will be high and the investors excited to trade it. And then basically it is like we evaluate the stock whether it is overvalued or undervalued. Let me show you an example. Company A has EPS earning per share is 1 ringgit and the current market price is 20 ringgit. When we calculate PE ratio for this company, RM 20 ringgit is current market price divided by earning per share, which is 1 ringgit. So we will get RM 20 ringgit as the PE ratio, which means company A pays 20 ringgit for each 1 ringgit in earnings. Let me explain you how to see whether the stock is overvalued or undervalued. Okay, this example, company A has PE ratio of 20 ringgit and company B has PE ratio of 30 ringgit, which means company A stock is undervalued because the PE ratio is low. So you can compare the value within the industry or different industries to see whether which company stock is overvalued or undervalued, to know which is cheaper or expensive.
ROI, or return on investment, tells you how much money your money is earned. And here is the ROI formula. It's really easy to use. ROI equals net profit divided by your investment times 100. And it's expressed as a percentage.
Return on investment is like you buy something for 1 ringgit and sell it to 2 ringgit. This means you get the 100% of return on investment. Okay, let me show you one example. Mr. J, he buy a stock at RM 2000. So it is his investment of 2000, and then 1 year later he sell the stock to 3000 ringgit. So this means he get the net profit of 1000 ringgit. So when we calculate the return on investment for him, this is the net profit 1000 and then divided by the 2000 is the investment that he made. So times with 100%, which means we will get 50% of return on investment. This means he already get back his money and more. So here he earned profit.
Now we are in the library, we can find the data string of the computer. First, open the Excel file. Press the Thomson Reuters. Sign in first. After sign, press the data string and time series request. Type the company that you want to find here. We take Nestle Malaysia as an example, and then the data types. Select the data that you want. First, price-earning ratio, and then total investment, return. Select it and then return. The start date 2015, the end date 2017. The date we want is yearly. After all this, submit it. And then the data that you need will come out. the data, NASO shows a fluctuation in price earning ratio and investment return. 2016 records the lowest figure at 26.8 and 10.22 for ratio and return respectively. The figure is decreasing from 2015 but increasing significantly in 2017. The positive relationship between the price earning ratio and total investment return can be seen in the NASO data performance. When the ratio is low, the return is low, and when the ratio is high, the return is also high. However, the investment with high P/E ratio is more likely to be considered as risky investment than those with low P/E ratios, since a high P/E ratio signifies high expectation. This is because investors are willing to drive up the price of the investment because they believe the company has good growth prospects and will make more profit in the future. This statement is supported by the data of NASO.
The table shows the data of Hang Seng industry. It shows up and down trend for their PE ratio and their investment return. Both PE ratio and return of investment are positively related each other. In 2016, the PE ratio decreased to 18.80, which makes the declining of investment return obviously from 67.70 to negative 4.65. Also in 2017, both PE ratio and investment followed the same direction by increasing in value to 19.50 and negative 1.71 respectively. The return on investment is reliable to the ratio of price earning, which means there is a positive relationship among them. As an indicator, PE ratio works as determination of future earnings for a company. The lower PE ratio in 2016 indicates the lower the expectation of earnings of the investor. As the PE ratio is going high in 2017, the return expected by the investor also higher towards this Hang Seng industry. When PE ratio is high, the stock is paying overvalued, whereas it can be riskier if the expectation does not confirm between the current and future. Okay, the next table shows the data of Apollo Food Holdings. The PE ratio follow equally upward with the investment return from 2015 to 2016. With PE ratio is from 13.90 to 19.30, the total investment return increased significantly from 0.42 to 38.27. This indicates the positive relationship between PE ratio and the return of investment. However, increase of PE ratio to 25.20 causes investment return reduced in 2017 to negative 11.76. An increase in PE ratio means the total investment return is going uptrend from 2015 to 2016. This positive relation shows the investment return drastically increases as the investors are expecting to have higher earnings. When the expectation is high, the investors are willing to purchase the overvalued stock of Apollo Food Holdings. Yet, the higher PE ratio does not meet the expectation of return on investment in 2017. The price earnings indicator is negatively related with investment return. In this case, it shows high PE ratio not necessarily affect the investor to have strong willingness to pay off every dollar of investment return. This is because the market price is higher than the fair value during the overvalued stocks being traded. It might be because of sudden high demand, since the investor too confident in their investment.
The next company is Ajinomoto. From this table, Ajinomoto show a fluctuation in price earning ratio and total investment return. there is a significant increasing from 11.2 to 18.5 and from 27.45 to 47.90 for price earning ratio and total investment return respectively in 2015 and 2016. For 2017, company faced decline in price earning ratio but experienced a higher total investment return. The increase in this ratio show a good development of company, and this ratio is high for the institution which expected to grow rapidly in future. Price earning ratio increase when investors are willing to pay more per unit of earning while the earning remains stable. The relationship between price earning ratio and total investment return for 2015 and 2016 prove there is a positive relationship as the higher the ratio, the higher the investment return investor will get. When a company has a low ratio as shown in 2017, it may indicate that the investment is undervalued. This is because the earning is stable and Ajinomoto not in the middle of the some financial scandal. This table shows the last company of Dutch Lady. This table shows increasing in both price earning ratio and total investment return from for 2015 and 2016. When the ratio increases, the total investment return will increase as well. However, in 2017, companies show increasing in ratio but significant decline in investment of return. It is very clear that the relationship between the price earning ratio and the return is positive, which means the higher the ratio, the return that investor get also higher. Nowadays, company in food industry show the higher of popularity, and this tends to have high ratio reflecting a growth in orientation. For Dutch Lady data on 2017, it showed there is decline in investment return, but the ratio show increasing data. This shows negative relationship between ratio and return, which means the stock market is higher but the investor get lower return. This may cause due to the overvalue investment. Overvalue investment means traded in market price that is significantly higher than the fair value.
In conclusion, we can see that the 3 out of 5 companies show that when PE ratio increase, their ROI also increase. Except for Nestle, Malaysia and Hap Seng Industry from 2015 to 2016. But both of the companies give positive relationship between PE ratio and ROI compared to other companies in year 2017. For the other companies, such as Apollo, Food Holdings, Dutch Lady, and Ajinomoto, it shows negative relationship between PE ratio and ROI. In the past 2 years, 2016, there is strongly side that to positive relationship between PE ratio and the ROI. But in current year, which is 2017, it shows negative relationship between PE ratio and investment return. With the comparison results from 5 companies, it is mostly focusing on positive relationship between PE ratio and return on investment. The higher PE ratio, the higher the investment return, and also lower PE ratio reduce the return investment.